Good afternoon, and thank you for joining today's webinar. This is Becky Masick with FHFA's Office of Congressional Affairs and Communications. The purpose of this webinar is to make you aware of FHFA's rulemaking on Federal Home Loan Bank, system boards of directors, and executive management, and to provide you with an overview of key components of the proposed rule. Before I turn it over to FHFA Deputy Director of Bank Regulation, Joshua Stallings, a few quick housekeeping items. Nothing in this meeting should be construed as binding on or a final decision by the FHFA Director or FHFA staff. This presentation is for informational purposes only. We will not be accepting any comments or questions during the webinar, but encourage you to submit comments on the proposed rule in writing through the FHFA website. Please email mediainquiries@fhfa.gov with any questions. FHFA will accept public comments on the proposed rule for 90 days following its publication in the Federal Register in accordance with the submission instructions in the rulemaking document. Information on how to submit comments will be provided at the conclusion of today's webinar. If you are experiencing technical issues, please email FHFA Communications at fhfa.gov for support. As a reminder, this event is being recorded and will be available on our website at fhfa.gov and our YouTube channel. And with that, I'll turn it over to Joshua Stallings.
Good afternoon, and thank you for joining us. I am Joshua Stallings, Deputy Director of the Division of Bank Regulation. I just wanted to acknowledge the continued effort that we are underway with here at the FHFA related to recommendations coming out of our Federal Home Loan Bank System at 100 report that we issued last November. This is one of the first two notices of proposed rulemakings that we've come out with. We felt that this one deserved a little more explanation from the agency to kind of make sure people had some clarity of the actions we're taking, because there are several items within the notice of proposed rulemaking. So with that being said, let's just get right into this thing. I'm going to turn it over to Eric Raudenbush, who is our Managing Associate General Counsel in our Office of the General Counsel, who's going to walk everybody through what we're proposing with this new rule. Eric, take it away.
Okay. Thank you, Joshua. It's so wonderful to see so many people interested in spending a Wednesday afternoon learning about Federal Home Loan Bank corporate governance. We have a lot to get through, so I will dive right in. Next slide, please. This gives a little outline of our agenda. The proposed rule covers an array of issues concerning the boards of directors of the Federal Home Loan Banks and, to some extent, the Office of Finance, as well as a few non-board level corporate governance issues. So we have grouped them accordingly. I'm going to give the high points as expeditiously as I can, but I will provide appropriate context where needed to make clear the nature of the revision. I urge everyone to read the rule preamble, which will give more context, as well as policy and legal explanations. This goes without saying, but when I refer to a bank in this presentation, I am referring to a Federal Home Loan Bank. Next slide, please. Okay, the proposed revisions in this rulemaking stem from a variety of sources, including action items that appeared in FHFA's Bank System at 100 report, which was issued in November of 2023, from stakeholder comments received in response to FHFA's Notice of Regulatory Review, which was published in the spring of 23, from various requests from the Federal Home Loan Banks over the years for greater clarity and transparency on bank directorship issues, and otherwise on conclusions drawn from FHFA's general supervision of the banks. Now, many of the revisions in this rule, probably more than half text-wise or word count-wise, as well as related discussions in the rule preamble, are meant only to provide greater clarity on existing requirements, processes, and authorities pertaining to bank directors without affecting any substantive change. These types of clarifying revisions pertain mostly to provisions addressing the annual designation of directorships process, through which FHFA sets the size and composition of each bank's board for the following year, as well as provisions addressing director eligibility, the director nomination and election processes, and the filling of vacant directorships. And the remainder of the proposed revisions are substantive in nature, and those are the ones that we'll be focusing on in this presentation. And some of the substantive changes being proposed would simply codify existing guidance or practices, and while others would add substantive requirements, and in some cases provide the banks and the Office of Finance with new authorities or flexibilities. Next slide, please. Okay, so the first grouping, general grouping of the two, is dealing with requirements for bank directors and nominees. And I want to give a little bit of background on that before we dive in. So the majority of substantive revisions relate to this category. We've tried to group them in as well as possible into subcategories to make it easier to digest. It doesn't work perfectly, but I think we'll get along quite well the way we have it organized here. By way of background, as many of you know, each bank's board of directors consists of both member directors, which must comprise a majority, and they are drawn from officers and directors of members in the respective states of each bank district, and independent directors who are elected on an at-large basis and may not have any material connection with any member of the bank or recipient of advances from the bank. The Federal Home Loan Bank Act requires that at least two of a bank's independent directors qualify as so-called public interest independent directors, and that the remainder meet different requirements pertaining to what the proposed rule creatively refers to as regular independent directors. So we will get into the differences between those two types of independent directors as we go along here, but we're going to begin by talking about public interest independent directors. So next slide, please. Okay, so the Bank Act, as I will refer to it, requires that to qualify as a public interest independent director, an individual must have more than 4 years of experience in representing consumer or community interests on banking services, credit needs, housing, or financial consumer protections. The proposed rule would clarify that in determining whether a potential public interest nominee has represented consumer and community interests as required by the statute, a bank must conclude that the individual's activity in any of the 4 areas mentioned in the statute must have involved advocating for or otherwise acting primarily on behalf of or for the direct benefit of consumers in the community, and must have been substantial in terms of time commitment and responsibility. This simply codifies in the regulation guidance that has previously been provided by FHFA. The existing regulation requires that a bank consult with its Affordable Housing Advisory Council before nominating any individual or any independent directorship during the annual nomination process, the regular election process. The proposed rule would make express that a bank must also consult with its advisory council when filling a vacant independent directorship outside of the regular annual election process. The proposed rule would also make clear that a bank's board may redesignate a sitting regular independent director as a public interest independent director, assuming that the individual meets the legal requirements to serve in that position. FHFA has historically permitted this practice, but the proposed rule would make clear that authority. And it would also expressly permit a bank to redesignate a public interest independent director as a regular independent director, again, assuming all qualifications are met. Next slide. Okay, moving on to critical areas of knowledge and experience. This relates to the qualifications for regular independent directors. The Bank Act requires that each regular independent director, as we are calling them here, have a demonstrated knowledge of or experience in one or more specified areas, which are financial management, auditing and accounting, risk management practices, derivatives, project management, or organizational management. As permitted by the statute, FHFA has added the law to that list, and that appears in the regulation, the existing regulation. The proposed rule would add several more areas of qualifying experience relating to emerging risks and issues of growing importance. And those proposed are artificial intelligence, information technology and security, climate-related risk, CDFI business models, and modeling. If revised as proposed, the regulation would also allow the FHFA director to add other appropriate areas of expertise that may come up to the list without the need for a new rulemaking. The proposed rule would also add a provision requiring bank boards in selecting independent directorship nominees to give special consideration to individuals having relevant knowledge and experience gained primarily through full-time paid executive management or other senior positions, as opposed to through volunteer positions or service on other boards. The existing regulation authorizes each bank to conduct an annual assessment of the skills and experience possessed by its board of directors as a whole, and to determine whether the capabilities of the board would be enhanced through the addition of individuals with particular skills and experience. The proposed rule would make this annual assessment mandatory, although the rule does request comment on whether the frequency of the assessment should be something less than annually. Next slide, please. The existing regulation requires that a bank provide notice to each member in its district of the commencement of the annual election process. And although the regulation specifies certain information to be included in that notice, it overlooks a couple of crucial pieces of information, ones which the banks may in fact provide in practice, but we thought it was important to add them expressly into the proposed rule. I will avoid enumerating all of those here, but I will mention that while the existing regulation makes the inclusion of a brief statement of sought-after skills and experience contingent on the bank having carried out that assessment, the proposed rule would make the inclusion of that statement mandatory because, as I just mentioned, the annual assessment, or what may end up being another type of periodic assessment, would also be made mandatory. Similarly, the existing regulation requires each bank to prepare and deliver a ballot to each member institution eligible to vote in the election, and it specifies the contents of the ballot. Again, I won't elaborate on all of the requirements here, except to give a little context to the proposed revisions. So the existing regulation permits a bank to include the results of the currently optional assessment of board skills and experience. And again, as mentioned, that assessment would now become mandatory. And so the proposed rule would require a bank to include those results on the ballot, including any explanation for any differences between the statement appearing on the ballot and that might have appeared on the earlier election notice. The existing regulation also requires that the ballot include a brief description of the skills and experience of each nominee for an independent directorship and permits a bank to include a similar statement for member directorship nominees. The coverage of vital areas of expertise through member directors, where possible, would allow the bank to seek independent directors to cover some areas of expertise that senior officers and directors of bank member institutions would be less likely to have. So the proposed rule would also require the banks, instead of making optional the inclusion of the skills and expertise of member directorship nominees on the ballot. That is just to allow members to make informed decisions on those skills and experience issues when casting their ballots. Next slide, please. Okay, moving on to director independence. Obviously, we're referring to independent director independence here because member directors do not need to meet independence requirements. The proposed rule would make a few modest revisions to ensure that bank independent directors are truly independent of its member institutions. Paralleling the statute, the existing regulation prohibits seated directors from serving as an officer, employee, or director of a bank member, or of any recipient of advances from the bank, or of any other Federal Home Loan Bank. Independent director nominees are currently permitted to have any of those connections, provided the nominee relinquishes the position prior to being seated on the board. Under the proposed rule, the independence requirement would be extended to nominees as well as sitting directors. The existing regulation also provides that for purposes of determining compliance with the independence requirements, a bank must attribute to the independent director any officer, employee, or directorship position of the director's spouse. The proposed rule would further strengthen independent requirements by extending the attribution requirement to all immediate family members of the director or nominee, which would be defined to include a parent, sibling, spouse, child, or dependent, or any relative sharing the same residence as the director. Okay. Next slide, please. although this is not addressed in the existing regulation, it has been FHFA's practice to permit a former member director that is no longer affiliated with a member institution to become an independent director, either through the regular election process or through a vacancy appointment without any cooling off period after losing eligibility to serve as a member director, provided that the individual has the requisite qualifications and is not term limited. Under the proposed rule, a former member director would be required to be off the board for at least 2 years before returning to serve as an independent director. And finally, with respect to director independence, the proposed rule would clarify the definition of the word advances for purposes of applying the prohibition against an independent director, or in case the proposed rule as a nominee serving as an officer, employee, or director of any recipient of advances. So this prohibition affects the ability of an individual affiliated with a non-member housing associate of the bank to serve as an independent director. In order to prevent banks from circumventing the independence requirements, FHFA has in recent years interpreted the word advances in this context as including any kind of loan to the entity, including the purchase of debt securities of the entity. The proposed rule would scale this back somewhat by defining the term advances to mean, in this context, again, any type of loan from a bank to the recipient, regardless of form or nomenclature, except for debt securities traded in the public capital markets, meaning that an individual affiliated with a housing associate could serve as an independent director, even if the bank held publicly traded securities of the entity. And this is intended to prevent the banks from skirting the independence requirements by creating bespoke lending terms for the housing associate by which an independent director or nominee is employed in an arrangement called something other than an advance, but allowing the banks to support their housing associates through the purchase of debt securities in the open market on the same terms and conditions that are applicable to other market participants. Next slide, please. Okay, so the proposed rule also includes a number of provisions addressing the bank's ability to deal with and address fitness to serve in a fiduciary role with the bank. Pursuant to FHFA guidance, in recent years, the banks have generally conducted background checks on independent directorship nominees, and the proposed rule would codify this as a requirement. The rule would also require each bank to conduct a background check on nominees for a member directorship, given that the risks background checks are designed to mitigate are no less of a concern for member directors than they are for independent directors. The proposed rule would prohibit a bank's board from nominating any person for an independent directorship or including on the election ballot any individual nominated for a member directorship without having first concluded through a thorough background check that the individual is fit to serve in a fiduciary role with the bank. Similarly, the rule would prohibit a bank from seating as a director any electee that it came to learn after the election is unfit to serve in a fiduciary capacity. With respect to sitting directors, the proposed rule would expressly establish the authority of a bank's board to remove directors for good cause pursuant to a duly adopted policy, which, as proposed, could be based upon violation of law or policy, threat of material, reputational, or other harm, physical or mental capacity, or continuous poor performance or lack of participation that is compromising the board's ability to adequately oversee the operations of the bank. So we understand that the statute vests in the bank's members the authority to select its board members. We do feel that needs to be balanced against giving the board the tools to deal with extraordinary issues that might come up with directors. And we certainly welcome your comments on where the appropriate guidelines should be on that, and for example, whether a 2/3 majority is the appropriate vote for something like that. Okay, moving on to a lot of people's favorite topic. Next slide, please. Director compensation. With regard to director compensation, the Bank Act authorizes each bank to pay its directors reasonable compensation subject to the approval of the bank system regulator. The existing regulation implements this by providing that the FHFA director may determine that the compensation to be paid to a bank's directors under its compensation policy is not reasonable, and the director may order the bank to refrain from making any further payments under the policy. The proposed rule would expressly allow, but not require, the FHFA director to establish and provide a notice of an annual amount of director compensation that is determined ahead of time to be reasonable. The existing regulation also provides that each bank's compensation policy must require that any compensation paid to a director reflect the amount of time the director spent on official bank business, and that compensation be reduced to reflect lesser attendance or performance at board or committee meetings during a given year. The proposed rule would expand upon this concept by requiring each bank to establish under its compensation policy a fair and impartial process for annually evaluating individual director performance and participation based on a number of factors that are enumerated in the proposed rule. The rule would further provide that the bank's policy provide for reduced pay to directors whose performance has been assessed as poor under the review process, and in extreme cases for removal pursuant to the removal policy that I mentioned previously. Next slide, please. With respect to director term limits, the Bank Act requires FHFA to adjust the lengths of director terms, which are generally set at 4 years, as necessary, so that roughly 1/4 of each bank's directorship terms expire each year. The existing regulation implements this primarily as a transition provision coming out of the HERA legislation in 2008. And while FHFA did, in a number of cases, truncate terms early on to achieve the statutory goal, the staggering at some banks has gotten a bit uneven over time for various reasons. The proposed rule would therefore expressly address FHFA's continuing authority to truncate term lengths when appropriate to maintain or restore a roughly equal staggering of terms on a bank's board. Not only is this consistent with the statutory intent, but it is also good corporate governance not to have a large percentage of directors potentially dropping off a bank's board in any given year. The statute and the existing regulation limit bank directors, both member and independent, to 3 full consecutive terms before they are ineligible to run again. And as does the existing regulation, the proposed rule would make clear that director terms that have been truncated to achieve equal staggering do not count as a full term for purposes of the term limit provision. It would also provide a bit more clarity on how the term limits are to be calculated when taking into account truncated terms and vacancy appointments where an individual has filled the remaining term of a director that has left the board. Next slide, please. Okay, so those are the high points of the proposed rule with respect to requirements for bank directors and nominees. And the rule also covers a number of other general corporate governance issues regarding the banks and the Office of Finance, which I will now go through quickly. Next slide, please. With regard to meeting requirements, the existing regulations, both the Part 1261 dealing with the banks and Part 1273 dealing with the Office of Finance, provide that each bank and the Office of Finance must hold a minimum of 6 in-person board meetings per year. The proposed rule would retain the minimum 6 board meeting requirement for both the banks and the OF, but would eliminate the requirement that those meetings be held in person. The rule would permit the banks and the OF to satisfy the minimum meeting requirement via video or teleconferencing or through a hybrid meeting format, provided that all directors have an opportunity to communicate and have access to all written documents and presentations, and that all attendees, both live and remote, are located within a U.S. state or territory that is part of a bank district. This essentially codifies a waiver of the existing regulatory in-person meeting requirements that has been in place since early in the COVID-19 pandemic. Next slide, please. On conflicts of interest, although each bank is required under the existing regulations to adopt a conflicts of interest policy to cover all of its board directors, there is currently no equivalent requirement with respect to bank employees. many of whom are in no less a position of trust at the bank than are its board directors. So the proposed rule would add a new requirement that each bank adopt a conflicts of interest policy covering its employees and would establish the requirements for those policies. The content and format of the provision would mirror, to some extent, the existing provision on bank director conflicts, appropriately modified to be applicable to bank employees. So I won't detail all of the requirements of those two provisions, except to mention that, as proposed, the rule would require each bank's policy to prohibit executive officers and senior management or close family members or associates from holding paid positions with any entity that is or may be eligible to become a member or housing associate of any bank or with any affiliate of such an entity. Otherwise, the rule would leave to the reasonable discretion of the bank what types of requirements to apply to other employees, and FHFA would expect the bank to appropriately calibrate the treatment of different types of employees under the policy according to the risks presented by their respective positions. The existing director conflicts provision that I just mentioned establishes parameters for dealing with situations where a bank director has a financial interest in a matter that is being considered by the bank's board. And for purposes of those requirements, the existing regulation excludes from the definition of financial interest any deposit or savings account maintained with a member and any loan or extension of credit obtained from a member institution in the normal course of business on terms that are generally available to the public. Now, in response to comments received on FHFA's notice of regulatory review, the proposed rule would expand that exclusion also to include other accounts and products obtained in the normal course of business on non-preferential terms generally available to the public, obtained from a member. The definition of financial interest, including the expanded exclusion, would apply to both the director conflicts provision as well as the new provision on bank employee conflicts. Next slide, please. In the area of records retention, the existing regulation includes a number of provisions requiring retention of director election ballots, nomination certificates, and other records relating to the nomination and election of bank directors. These provisions generally require that those materials be retained for a minimum of 2 years. The proposed rule would consolidate those provisions and generally increase the minimum retention period to 7 years, which is consistent with U.S. government standards as well as corporate best practices, we believe. Next and final substantive slide. The remaining 2 items are dealing with the division of duties between the board of directors and management of the Office of Finance. And these, again, are changes that are being made in response to comments that we received on the notice of regulatory review. The first one, the existing OF regulation limits OF operating fund withdrawals to check, wire transfer, or drafts signed by the chief executive officer or other persons designated by the OF board of directors. The proposed rule would update the regulation to permit the use of other widely accepted fund transfer methods that have been or will be developed in the future, and that the regulation will be expanded to allow signature authority to be delegated by the CEO as well as the board in accordance with OF governance documents. And finally, the existing regulation establishes as a duty of the OF board the duty to review and approve all contracts of the OF, except for contracts for which exclusive authority is provided to the audit committee by regulation. FHFA is proposing to loosen this requirement a bit and to require the OF board of directors to review and approve only those contracts that are specified in the corporate governance documents of the OF. And we believe this is consistent with best general corporate practices. And with that, let me say we welcome your well-considered comments, and I will hand it back over to Becky to explain how you can get those to us.
Great. Thank you, Eric, and thanks to everyone for joining us today. To submit comments on the proposed rule in writing through the FHFA website, you can scan the QR code shown on your screen, or you can go to FHFA.gov and under the About menu, click Rulemaking and Federal Register. Click the Open for Public Comment link at the top of the page, and then the Submit Comment button next to the proposed rulemaking. You'll see a form to enter your comment, or you may upload an attachment. Written comments must be received within 90 days after publication of the rule in the Federal Register. It's scheduled to be published on Monday, November 4th, so barring any changes, the 90-day comment period will close on February 3rd, 2025. As a reminder, this presentation was for informational purposes only. A recording will be available on our website at FHFA.gov and our YouTube channel shortly. Please email mediainquiries@FHFA.gov with any questions. Again, thank you for joining us to learn more about FHFA's proposed rule on Federal Home Loan Bank System Boards of Directors and Executive Management. Have a great day.